When a business purchases inventory for resale, for example chairs, it may also incur delivery cost. So this raises the question, how can we determine the cost of inventory? Is it just the cost of the chair? Or do we also need to include the cost of delivery? Product cost is one method that can be used to value the inventory purchased. To use product cost, it must be a cost that is incurred to bring inventory into condition and location ready for sale, and the cost can be logically allocated to individual units. In the example of the shark chairs, let's assume 50 units were purchased. The following costs were incurred. The shark chair cost $20 per unit, and the delivery cost was $500 for 50 units. The question is, how do we treat the delivery cost? To use product cost, we need to satisfy the following two criteria. We ask, is delivery cost incurred to bring inventory into condition and location ready for sale? In this case, yes, because delivery is incurred to bring the inventory into location ready for sale. The next question that we ask is delivery cost logically allocated to individual inventory? In this case, yes, because the delivery cost of $500 was only for the 50 units that were purchased, we can easily divide the $500 with the 50 units to get the per unit cost of delivery. Therefore, we include the delivery cost into the inventory unit cost. When we are recording product cost, we need to bear in mind that not all costs are incurred with the same supplier on the same date. Here are some different possibilities. We could have same supplier, same date. For example, the inventory and delivery costs were incurred with the same supplier on the same date. We could also have a different supplier with the costs incurred on the same date. For example, inventory cost and delivery cost may be incurred with different suppliers but incurred on the same date. We could also have a different supplier and different date. For example, the inventory cost and delivery costs were incurred with different suppliers on different dates. So here is scenario number 1, where all expenses were incurred with the same supplier on the same date. On the 5th of July, the business purchased 50 shark chairs on credit from Funny Chairs. The following costs were included in invoice 151 from Funny Chairs. Inventory cost, $20 plus GST per unit, and delivery cost was $500 plus GST for 50 units. So we divide $500 by 50 to give us $10 cost per unit. Therefore, the cost of 1 unit of chair is a total of $30. In the inventory card, we record the purchase of inventory in the in column, and here we can see a purchase of 50 units at a cost price of $30 per unit, giving us a total of $1,500. In the general journal, we record this increase in inventory by debiting the inventory account $1,500, and we add the GST by debiting $150 to a GST clearing account. And because this is a credit purchase from the supplier Funny Chairs, we record an increase in the amount owing to Funny Chairs by $1,650 credited to the accounts payable account. Here's scenario number 2, where expenses were incurred with different suppliers on the same date. On the 5th of July, we have purchased 50 shark chairs on credit from Funny Chairs, with the inventory cost $20 plus GST per unit. On the same date, July 5th, we have paid for delivery of 50 shark chairs, and this was paid to Quickie Drives, with the reference number check 99, and the delivery cost was $500 plus GST for the 50 units. We calculate the cost of 1 unit of chair the same way, which is to add the $20 inventory costs and the delivery cost of $10, giving us a total of $30 per unit. So here in the inventory card, we record the purchase of the inventory, which includes the delivery cost, and the total is 50 units at a cost price of $30 per unit, giving us a total of $1,500. So note in the document reference, we have made reference to invoice 151, which was the credit purchase of the chairs from Funny Chairs. We have also made a reference to check 99, which represents the payment to Quickie Drives for delivery. Here in the General Journal, we record two separate entries. Firstly, to record the credit purchase of the chairs with debit inventory $1,000. And note that this is represented by the $20 cost per chair multiplied by the 50 units. So this is only the supplier cost. We add the GST by debiting GST clearing $100. And we credit accounts payable Funny Chairs for the total of $1,100 owed to the supplier. Here in a separate entry, we record the delivery cost of $500 that is added to the cost of inventory. So therefore, we debit inventory account $500, debit GST clearing $50, and we credit bank $550, which is the payment that we have made to Quickie Drives for delivery. So scenario 3 is slightly different, where we have the expenses incurred with different suppliers on different dates. So on the 5th of July, we have purchased 50 shark chairs from Funny Chairs. The inventory cost $20 plus GST per unit. On a different date, July 10th, we have delivery of 50 shark chairs and cash was paid to Quickie Drives. The delivery cost was $500 plus GST for the 50 units. Note that when we are calculating the cost of 1 unit of chair, it is still the same, which is $30 per unit. And again, there is a slight difference in how we record the purchase of inventory in the inventory card and the general journals. So on the 5th of July, we can see that we are recording the purchase of the chairs with reference to invoice 151. In the in column, we record the purchase of 50 units at a cost price of $20 per unit. Note that this is only the supplier cost that we are recording at this point. In the balance column, we include the purchase of these 50 units at a cost price of $20 per unit. In the general journals, we record it the same way, where we record the purchase of inventory by debiting inventory account $1,000, debiting the GST $100, and crediting accounts payable $1,100, which represents the amount owing to the supplier. Now back to the inventory card. We can see on a separate date, which is the 10th of July, we have recorded the payment of delivery to Quickie Drives with reference to check 99. In the in column, we record the 50 units, cost price $10 per unit, which represents only the delivery cost of the chairs, which totals to $500. At this stage here, it is important to remember that we are not buying additional 50 units. Instead, we are only adding the additional cost of $10 delivery cost to the inventory cost. So here in our balance column, we can see that the balance of our inventory of the new batch that we've just bought is now 50 units with a cost price of $30 per unit. Now back to the general journals. On the 10th of July, we are recording the delivery cost of $500 added on to the inventory cost by debiting $500 to inventory account, and we add on the GST $50, and we credit the bank $550, which represents the payment made to Quickie Drives for delivery cost. The other method that may be used to value inventory purchased is period cost. It is only used when cost is incurred to bring inventory into condition and location ready for sale, and the cost cannot be logically allocated to individual units. This time, we're purchasing 50 units of the shark chairs and 10 units of the couches. We've also paid delivery costs to have both these chairs and couches delivered to the business. The question is, how can we determine the cost of inventory? Again, we ask ourselves the same two questions. Firstly, is delivery cost incurred to bring inventory into condition and location ready for sale? In this case, yes, delivery cost has been incurred to bring the inventory, both the shark chairs and couches, into location ready for sale. Secondly, is the delivery cost logically allocated to individual inventory of shark chairs and couches? This time, no, it cannot be logically allocated to the individual units. The reason being is because both the shark chairs and couches are very different inventory, and it's impossible to reasonably attribute the delivery cost to the shark chairs as well as to the couches. So in this case, we exclude delivery cost from inventory unit cost. Let's take a look at this example here. On the 5th of July, the business purchased 50 shark chairs and 10 couches on credit from Funny Chairs. The following costs were included in invoice 151 from Funny Chairs. The shark chairs cost $20 plus GST per unit. The couches cost $800 plus GST per unit. And the delivery cost was $500 plus GST for both the shark chairs and couches. The cost of one unit of shark chair will be $20 per unit, and the cost of one unit of couch will be $800 per unit. The delivery cost will be separately recorded as period costs under this method. Now let us have a look at how we record the purchase of shark chairs and couches in the inventory cards. So firstly, in the inventory card of shark chairs, we can see that on the 5th of July, we have recorded the purchase of the 50 units of chairs at a cost price of $20 per unit. Whereas on the other hand, in the inventory card for couches, we recognize the purchase of 10 units of couch with a cost price of $800 per unit. In the general journals, we debit the inventory account $9,000, and this is the total supplier cost of the shark chairs and couches. Then we separately record the delivery expense by debiting $500 to the account. Note that delivery expense here is treated as a period cost, and therefore it is separately recorded and not included under the cost of inventory. Then we calculate the GST amount, which is $950 debited to the GST clearing account. The total amount owing to the accounts payable is therefore $10,450 that is credited to the accounts payable. In the event the costs have been incurred with different suppliers and or different dates, we record the same way as shown earlier under product cost. Now we're going to compare between the product cost method and the period cost method. And we're going to see the different effects that they have on the income statement and the balance sheet. For the purposes of comparison, we will just look at the 50 shark chairs and we'll ignore the purchase of couches. Now in the case where product cost was used, where only shark chairs were purchased, the inventory cost price recorded for each unit of the shark chair would be $30 per unit, and this represents the $20 supply cost plus the $10 delivery cost. On the other hand, if period cost was used in a case where the shark chairs were purchased alongside other inventory, which were the couches. In this case, the inventory cost price recorded for each unit of the shark chair would be $20 per unit, which represents only the supplier cost. Now let's assume 30 units are sold for $50 plus GST per unit. This is the selling price. If we are using the product cost method, the cost of sales calculation will be $30 times the 30 units that are sold. This gives us a cost of sales totaling to $900. On the other hand, if we are applying the period cost, the cost of sales calculated for the 30 units sold will be the $20 cost price times 30 units. This will give us a total cost of sales of $600, which is lesser than what it was if the product cost was used. This is where we can identify the different effects that the product cost and the period cost methods have on profits, which are reported in the income statement. Here we are selling 30 units for $50 plus GST per unit. We use this selling price to calculate the sales revenue, which works out to be $1,500. Note how the sales revenue is the same even if we are using product cost or period cost method. The difference lies in how we account for and report for cost of goods sold. Let's start by looking at the product cost method. Earlier, we have calculated the cost of sales to be $900. Under the product cost method, we have assumed that the delivery cost could be logically allocated to the individual inventory units, and therefore the delivery cost has been incorporated into the per unit cost price of the inventory. On the other hand, with the period cost method, we have assumed that the delivery cost could not be logically allocated to the individual inventory units. Therefore, the delivery cost has been excluded from the per unit cost price of the inventory. Instead, the delivery cost is written off entirely as period cost in this period. Because in the differences in the way that we treat the delivery cost, this results in a very different cost of goods sold expense amount. So under the period cost method, we can see that we end up with a higher cost of goods sold expense compared to what it is if we used the product cost method. Therefore, overall, with the period cost method, we end up with a lower profit because we had a higher cost of goods sold expense. Whereas on the other hand, with the product cost method, we end up with a higher profit because we had a lower cost of goods sold expense. Here we can also see the different effects on the balance sheet between the two methods. So we started off with 50 units, we sold 30 units, and this leaves us with 20 units of inventory left on hand. Under the product cost method, we value the inventory on hand by taking the $30 cost price per unit multiplied by the 20 units of inventory on hand. This gives us a total value of inventory of $600. On the other hand, using the period cost method, we value the inventory on hand by taking the $20 cost price per unit multiplied by the 20 units of inventory on hand. This gives us a total of $400. So what we can see here is that between the two methods, the product cost method gives us a higher value of inventory and therefore gives us a higher valuation of assets. On the other hand, the period cost gives us a lower valuation of assets. So this leads us to our next question. Should we use the product cost method or the period cost method? Should we look at the profits in the income statement, or do we look at how high our assets are valued in the balance sheet? Or perhaps, does it not matter? From our comparisons, we have worked out that the product cost gives us a higher profit and a higher asset. So in the first instance, we may be tempted to think that, oh yeah, we should go with the product cost because it makes our business look a lot better. But the truth is, it does not matter. Once all units of inventory are sold, the total profits made would be the same, and there will be nil inventory left on hand. Here we have a hypothetical situation where we are assuming that all 50 units are sold within the same period for $50 plus GST per unit. We use this selling price to calculate the total sales revenue, which this time works out to be $2,500 for the 50 units sold. The sales revenue is the same even if we are using the product cost or period cost method. Now let's look at the cost of goods sold under the product cost method. Here we have cost of sales calculated to be $1,500. We work this out by taking the $30 per unit cost price, which included the delivery cost, and we multiply this by the 50 units sold. On the other hand, with the period cost method, we work out the cost of sale by taking $20 per unit cost price multiplied by the 50 units sold. And this $20 per unit excluded the delivery cost from the calculation of the per unit cost price. Instead, we can see here that the delivery expense has been written off entirely as period cost in this period. This gives us a total amount of $1,500 of cost of goods sold expense under the period cost method. As we can see here, when all units of inventory are sold, the cost of goods sold expense works out to be the same between the period cost method and the product cost method. This results in the same amount of profits under the both methods when all units of inventory have been sold. So this means that we cannot rely on the differences in the profits and inventory valuation to decide if we should use the product cost or period cost method. Instead, we need to use this criteria to decide. We ask ourselves two questions. Is the cost firstly incurred to bring the inventory into condition and location ready for sale? And secondly, is the cost logically allocated to the individual inventory? If the answer is yes to both, this means that we should use the product cost method, where we include the cost as part of the inventory per unit cost. If the answer is yes to the first question, but no to the second, it means that the expense cannot be logically allocated to the individual inventory. In this case, we use the period cost, where the expense is reported as period cost under the cost of goods sold in the income statement for the period. If the answer is no to both questions, this means that the cost is not inventory related at all, and therefore we report this expense as other expense in the income statement. Here are some links to the qualitative characteristics, faithful representation, and relevance in our decision between using the product cost or period cost method.